Welcome to the Deep Dive. We're here to cut through the noise, get past the headlines, and really synthesize the knowledge you need. And today, well, we're tackling maybe the biggest question out there right now, the one hanging over the whole global economy. When will the U.S. economy crash? And maybe more importantly, how bad is it actually going to be? Yeah, we've gone through a whole stack of sources for this one, and the thing that jumps out is just how unified they are. The alarm bells are ringing. They're basically saying, look, this isn't just another warning. All the fundamental red lights, they're flashing at the same time. So our mission today is to unpack that, to really understand this unprecedented mix of internal fiscal problems and these external geopolitical pressures. Because expert analysis is actually starting to point towards a specific time frame for potential disaster.
And we need to be clear, this isn't just about predicting a standard recession. What the sources are consistently warning about is a downturn that could be, and I'm quoting here, worse than you've imagined. The real danger, you see, lies in this unique cocktail of threats. You've got these self-inflicted wounds, things like domestic policy choices, serious financial mismanagement happening alongside these growing external challenges. Challenges to the very structure that's held up the dollar for what? 80 years now?
80 years.
We really have to look closely at the data itself, the integrity of the numbers, because that's often the first place you see the cracks appearing in the foundation.
Okay, right. So let's start there with those cracking foundations, the core internal fiscal signs that suggest the economic engine isn't just slowing down, it's actually sputtering.
Mm-hmm.
And you mentioned data integrity. We should probably begin with the labor market then. That's usually seen as the bedrock indicator of economic health. But recently it gave us one of the most immediate and, frankly, shocking warning signs.
Yeah, the integrity of the data itself is under intense scrutiny right now. Policymakers, investors all over the world, they relied on this stuff. And what our sources really highlight as troubling is this quiet reversal by the Bureau of Labor Statistics, the BLS. It happened leading up to August 2025. They basically walked back their own reports.
Walked them back how?
Well, this is a major challenge to the trust people put in the whole U.S. economic reporting system, right? The BLS, they give us that monthly snapshot of American jobs. Earlier in 2025, specifically May and June, they claim the economy added over 331,000 jobs. Big numbers, used everywhere to signal, strong growth, robust recovery.
Okay, I remember that. But those gains?
They just vanished. Poof. The BLS quietly admitted those 331,000 jobs they claimed, they never actually happened.
It never happened. How does that work?
It's sometimes called benchmark revisions. It's not totally unheard of, but the scale of this reversal, this correction, is just staggering. It really makes you question the methods they're using. Are they leaning too heavily on, say, household surveys, which can bounce around a lot instead of the more solid, firm payroll data? When you have a gap that big, it means everyone, the public, the markets, was working off a fundamentally false picture of economic strength for months.
And then the actual report for July 2025, right after this whole mess came out, it didn't exactly inspire confidence, did it?
Not at all. It reported only 73,000 jobs created. That number was so low. I mean, it seriously undershot even what the most pessimistic analysts were expecting. A real miss.
So zooming out then, the trend is pretty clear.
Oh, absolutely. If you look beyond just 1 month, the pattern is unmistakable. It's a collapse. It confirms that the BLS's earlier positive spin was just wrong. And we have other data to back this up. Arizona State University's Seidman Institute, their data really puts the severity of the slowdown into context. They project job growth for all of 2025 to crash down to just 0.45%.
Okay, 0.45%. Let's put that into perspective for people listening. How does that compare?
Well, think about it. That 0.45% is a massive drop from the 1.04% they reported just the year before in 2024. And if you compare it to the big rebound after COVID back in 2021, which was like 5.77% growth, you see this incredibly sharp halt, almost instantaneous.
So the engine isn't just slowing, it's seizing up.
Exactly. It's seizing up. And you have to remember, job creation, that's the lifeblood of tax revenue, isn't it? That's how the government pays its bills, services its debt. So a slowdown like this in the job market, it's a crystal clear signal that the money coming in down the line won't be enough to cover what the government already owes.
Which brings us, perfectly to the absolute core of the U.S. fiscal problem.
Yeah.
The debt monster. This enormous growing pile of government debt that's eating up more and more of our revenue just to pay the interest. If the job base is faltering, like you said, then our ability to actually pay that interest, it becomes seriously endangered.
Yeah, the government's whole financing model, It's way past just being unsustainable now. It's actually becoming actively hostile to the country's future economic health. It sometimes helps to think of the federal government like a giant household budget, right?
Okay.
If your household brings in money, that's revenue, but spends way more expenditures, the difference is the deficit. And all those deficits piled up over time. That's the total debt. Now, historically, running deficits made sense during, say, a major war or for massive infrastructure projects. But now the debt is just ballooning even while growth is stalling out.
And the scale is just hard to wrap your head around. Our sources mention that in 2024, the government took in about $4.92 trillion, but it spent $6.75 trillion.
Leaving a gap, a deficit of $1.83 trillion just for that 1 year.
Wow. And how does the Treasury cover a gap that big?
By selling IOUs, basically. Issuing securities. Borrowing the money.
But the real kicker isn't just the total amount of debt, is it? It's the cost of carrying it.
Precisely. The cost is escalating dramatically. Right now, the U.S. is spending over $881 billion a year just on interest payments, just interest.
$881 billion.
And that number is projected to blow past the $1 trillion mark in 2026. $1 trillion a year just servicing the debt. But what's truly shocking, I think, is the opportunity cost, what we lose by spending that much on interest.
Right. Let's focus on that. What does that $881 billion, soon to be $1 trillion, actually mean in real terms? What isn't getting done?
It means that money basically evaporates from the U.S. budget. It gets transferred to creditors around the world, big investment banks, foreign central banks, even domestic bondholders. That $881 billion, soon $1 trillion, is money that cannot be used for, say, fixing bridges, funding cutting-edge scientific research, or investing in education to boost future productivity. It's a direct drain on our future growth potential. And what's more, our sources show that debt repayment, just the interest, has become the second largest item in the entire federal budget. Only Social Security is bigger.
Hold on, I want to make sure everyone heard that correctly, because that's a massive historical shift. The U.S. is now spending more paying interest to its creditors than it spends on its entire national defense budget.
Yes, or on Medicare.
Or Medicare. Wow.
Absolutely. That money is flowing out, servicing old debt, before it can even fund core government functions like defense or healthcare.
So when debt service costs more than defense, that signals a huge change in national priorities, doesn't it? Not by choice, but just fiscal necessity.
Exactly. And it leads to this really alarming implication. The U.S. is getting incredibly close to the point where a full 25%, 1/4 of all the tax revenue it collects, goes just to paying interest on existing debt.
25%. Imagine that for your own household budget.
Yep.
A quarter of your paycheck got immediately to credit card interest before you even buy groceries or pay the rent.
It's deeply unsettling. And it feeds directly into this potential vicious cycle of debt we hear about.
Right. So if foreign creditors, that they who buy U.S. debt, maybe China's central bank, sovereign wealth funds, if they look at our recent shaky GDP growth, the corrected job numbers, they start to lose confidence, right? Confidence that the U.S. can actually generate enough future tax money to pay them back. What happens then?
Well, they demand a higher price for the risk they're taking. It's basic finance. They say, okay, U.S. Treasury, you want us to lend you another $100 billion. Given your slowing economy and rising risk profile, we need a better return. We need a higher interest rate.
It's standard bond market behavior.
Completely standard. And the U.S. Treasury, they don't really have a choice but to accept that higher rate if they need the cash, which they do.
So the government ends up borrowing new money at a higher rate just to make the interest payments on money they borrowed before, which just increases the total debt further.
That's the vicious cycle, precisely. Those higher interest rates immediately force the U.S. to spend even more on debt service in the next budget cycle, which forces them to borrow even more money to cover that bigger interest bill.
All at those new higher rates.
Exactly. It rapidly accelerates the whole crisis. Borrowing costs spiral up, which can spook international markets even more, maybe raising fears of a U.S. default, even if it's unlikely, which would push rates higher still. It's this mechanical feedback loop. And it's why the combination of really high debt and suddenly stalling growth is just so potentially lethal.
Okay, that fear of default, or even just the instability baked into that debt cycle, that transitions us perfectly into the next big piece. The stability of the dollar itself. I mean, when the U.S. went off the gold standard decades ago, the dollar wasn't backed by gold bars anymore. It was backed by, as our sources put it, far more ephemeral things. Three key pillars, really. And the worry now is that those pillars are looking incredibly vulnerable.
Yeah, it's absolutely crucial for listeners to grasp these three pillars. They're what underpins the dollar's status as the world's reserve currency. And that status gives the U.S. enormous financial power and stability, or at least it has. Okay, so pillar number one, trust in international norms. At its core, the dollar is backed by the U.S. government's promise, its legal guarantee to repay its debts. But that trust isn't just about the law. It's maintained by the U.S. acting like a reliable, predictable leader on the world stage. If the U.S. starts acting like what the sources term a rogue state, ignoring established international rules about fair trade, how military forces use, disrespecting institutions like the WTO or the IMF, then global faith in those U.S. guarantees starts to fade.
So if Washington starts making big economic moves based just on sudden political whims, the rest of the world starts wondering if U.S. laws and promises, including repaying debt, are really sacred anymore.
Precisely. Why would, say, Japan hold trillions in U.S. Treasury bonds if they suddenly fear those assets could be frozen overnight because of some unexpected political spat? If the world loses faith that the U.S. will fundamentally play by the rules it largely helped create, then their faith that the debt will be repaid safely and predictably also erodes. And that instantly hits the dollar's perceived value and cranks up our borrowing costs.
Okay, that makes sense. Pillar 2 then connects right back to what we were just talking about, economic productivity.
Right. Historically, the U.S. economy has been the world's most productive engine. That was always the ultimate backstop. Creditors were confident that no matter who was in the White House, the sheer power of the U.S. private sector would generate enough tax revenue to cover the government's debts. The economy itself is the guarantee.
And that's exactly why that jobs data we discussed in Section 1 is so deeply worrying, isn't it?
It is, because if that engine stalls, if that productivity growth sputters, as suggested by that sharp drop in job creation, then the second pillar gets weak fast. Creditors who've happily bought U.S. debt for generations start getting, well, understandably nervous, because the underlying machine that guarantees their investment return seems to be failing to keep pace with the liabilities it needs to support.
Okay, trust and productivity. What's the third pillar?
The third one is global demand, which is basically its reserve currency status. And this might be the most powerful pillar of all. The U.S. dollar is the main currency used for global trade. Oil, copper, wheat, microchips largely priced in dollars. This makes international transactions way simpler and guarantees payment for everyone involved. This massive built-in global demand for dollars creates incredible value and stability for the U.S. economy. But, it also benefits the whole world by making commerce easier.
Well, what happens if that global demand dries up?
Well, the cost of losing that demand, that's where the consequences get really severe. Look at what happened to Russia after the sanctions hit following the Ukraine invasion. Because of the political instability in the sanctions, its remaining major trading partners, especially India and China, started demanding payment for energy and goods in their own currencies, like the Indian rupee.
And the result for Russia was?
Russia ended up stuck with billions of dollars worth of Indian rupees that were basically unusable outside of India.
Why unusable?
Because not enough other countries or international businesses want to hold or accept rupees for major global transactions. And Russia couldn't possibly buy enough goods from India to spend all those rupees. So it highlights perfectly what happens when global demand and trust in a currency just collapse. It becomes illiquid, it traps wealth, it makes it incredibly difficult for that country to trade internationally.
That structural vulnerability, that reliance on global demand, that brings us to the temptation of just printing money, doesn't it? If the government faces huge debts and these pillars are shaky, why not just fire up the printing presses?
Right, there's always that temptation. We saw a limited version of this, often called quantitative easing or QE, after the 2008 crash. Printing some money can help stimulate a shrinking economy during a deep recession.
But what happens if the printing gets aggressive and the economy isn't in a deep recession, if it's not growing enough to sort of soak up that new cash?
That's the critical difference. It's about printing money that isn't backed by a corresponding increase in real economic value in goods and services. If the government prints too much money too aggressively, without that real value creation behind it, the supply of dollars just outstrips the demand for them. That dilutes the value of every dollar already out there, and that, by definition, is inflation.
Which means the dollar you promised to pay your creditor back with tomorrow is worth less than the dollar they lent you today.
Precisely. And creditors, especially the big sophisticated ones like foreign central banks or major investment funds, They watch money supply figures and inflation expectations like hawks. They haven't forgotten the trauma of the 1970s stagflation here in the U.S. High inflation combined with stagnant growth. If they even suspect the U.S. is resorting to aggressive, unbacked printing,
They notice fast.
they notice fast and they react. They'll demand higher interest rates immediately to protect the real value of their investment return against that expected inflation. Or worse, they might just start selling off their U.S. debt holdings altogether, looking for a more stable currency.
And that financial punishment makes it even harder and more expensive for the U.S. to borrow money in the future.
Exactly. It just feeds back into that debt spiral we talked about, making it accelerate even faster.
Okay, so we've got the debt monster looming, the dollar's pillars looking shaky. Now let's pivot to internal policies. Things the U.S. is doing, according to our sources, that are actively making the economy weaker. A kind of self-sabotage. We really have to start with tariffs, don't we?
Yeah, tariffs are a really critical, immediate factor driving some of the economic pain right now. Let's define them simply first. A tariff is just a tax imposed by the federal government on goods imported from specific countries. But here's the crucial part, the bit that often gets misunderstood. The tax isn't paid by the company in China or Mexico exporting the goods. It's paid by the company importing the goods here in the U.S. And those are overwhelmingly American businesses.
So when you strip it down, a tariff is basically a direct federal tax slapped onto American businesses.
Correct. And what do those businesses do when their costs go up because of a new tax?
They pass it on to the consumer, higher prices.
Exactly. The intended idea behind tariffs, the theory, is that making imported goods more expensive will encourage U.S. companies to say, hey, maybe we should make this stuff domestically instead, boost U.S. manufacturing.
But that runs into a major structural problem, right? The U.S. lost a huge chunk of its manufacturing base over decades. You can't just flip a switch and bring it all back overnight.
Precisely. Decades of offshoring companies moving production overseas to find cheaper labor or looser regulations has hollowed out a core part of the U.S. economy. And this structural gap means that when you impose tariffs now, they mostly just act as a tax increase. They don't immediately spark a wave of new domestic factories opening up. Our sources really underscore how serious this hollowing out is. They note that the Defense Department, the Pentagon, now explicitly views the lack of a strong, diverse manufacturing base as a critical national vulnerability if a major war were to break out.
That's a chilling thought from a strategic perspective.
Yeah.
And the practical reality on the ground is starting up new factories, new production lines. It takes massive investment, years of planning and building. It's not a quick fix.
Not at all. Which means, in the meantime, in the short term, Americans just end up paying more for everyday goods they rely on. Things like appliances, electronics, car parts. And this policy is hitting at possibly the worst time, adding another burden on consumers already squeezed by wages not keeping up, growing wealth inequality, and sky-high housing costs. So tariffs are actively slowing down GDP growth while making life more expensive, especially for average working families.
And almost unbelievably, as if undermining manufacturing wasn't enough damage, we have to talk about the deep, self-inflicted wounds happening in another fundamental sector, agriculture. The agricultural labor crisis, driven by immigration policy changes, is causing absolutely staggering economic losses right now.
Yeah, the sources are really specific about how dependent U.S. agriculture is on immigrant labor. Overall, it's over 50%. But in key regions like California, which grows so much of the nation's fruits and vegetables, that number climbs towards 70%. And we're talking about crops that need hands-on work, right? Many specialty crops, berries, lettuce, delicate fruits, they require careful handpicking. Current automation technology often isn't good enough, or it's just way too expensive for most farms.
And the current immigration enforcement climate, the raids, the fear it's created is pervasive anxiety among farm workers, hasn't it? Even for those who might be here legally, people are just afraid to show up.
The impact on the available labor supplies has been dramatic. Let's look at the numbers our sources provide because they show just how steep the drop was. In 2024, during the peak harvest season, estimates were that U.S. farms had about 85% of the laborers they actually needed. Still a shortage, but manageable for some. By 2025, that figure plummeted, down to a critical low of just 62% availability.
62%, that's a massive drop. More than a fifth of the needed workforce are gone in a year.
Yeah, 23 percentage point collapse. And that translates directly into crops left rotting in the fields because there's no one to pick them.
And that shortage isn't just theoretical. It has real, quantifiable economic consequences that hit farmers hard and then hit us, the consumers, right in the wallet.
Absolutely. Directly because of that labor shortage, overall crop yields shrank by a massive 14% in just 1 year. For the farmers still trying to operate, their production costs shot up by almost $500 per acre. Why? Because they either had to pay much higher wages to attract the few workers available, or they just had to abandon fields entirely, write them off as a loss. And the result for shoppers? An overall 8% increase in food prices so far, directly linked to this labor issue.
And these aren't just abstract national numbers. We're seeing devastating local impacts too, right?
Definitely. California, being the biggest agricultural state, felt it acutely. Estimates of crop losses there range from $3 billion to $7 billion in certain areas, just due to the labor flight. Prices for specific California-grown items spiked anywhere from 5% to 12%. Look at Georgia, another big agricultural player. They reported losing $140 million worth of crops simply because they couldn't get them harvested. Some sources even estimate that if all current undocumented immigrant labor vanished from U.S. farms instantly, the total drop in agricultural output could be somewhere between $30 billion and $60 billion a year.
Okay, so here's where the different policy failures create this tragically ironic feedback loop, compounding the problem.
Yeah.
Because American farms are losing so much production due to the labor crisis.
We become much more reliant on imports to fill the shelves in our grocery stores. We need to bring in more food from Mexico, Canada, South America.
And those food imports are then subject to
The very same tariff regime we just discussed. It's an absolutely debilitating 1-2 punch for the American consumer.
First, our domestic food supply shrinks and gets more expensive because of labor policy failures. Second, the imported food we need to fill the gap becomes hyper-expensive because of trade policy, because of the tariffs.
Exactly. The U.S. government's own policies, working in combination, are actively driving up food inflation and hammering the average household budget. It really is a case study in structural self-sabotage.
Okay, so let's talk about the pressure cooker that creates for the average American. We've got these self-inflicted wounds driving up costs, especially for food. But there's also this lingering general inflation, isn't there? Even though the headline numbers have cooled off a bit from the crazy peaks in 2021, 2022, prices for the absolute essentials feel like they've stayed stubbornly high. It's draining people's savings.
That's absolutely the lived financial reality for most people right now. The price of gasoline might bounce around, but the core stuff, housing, healthcare, and especially food, they just remain overheated. Our sources consistently point out that grocery prices, just on average, are still 20% higher across the board than they were back in 2019, before the pandemic chaos really hit. And this sticky, concentrated inflation on the things you have to buy, the necessities, it just eats away at any extra money people might have. It forces more and more households into taking on dangerous levels of credit card debt just to try and maintain their basic standard of living.
And the reasons behind these relentless food price hikes, they're complex, aren't they? It's not just the labor issue or tariffs. We still have lingering supply chain snarls from the pandemic.
Definitely remnants of that. But we also have huge geopolitical factors and increasingly climate factors pushing costs up relentlessly. Think about fuel and transportation costs. They affect every single step in getting food from the farm to your table. And those costs are being driven higher partly by the war in Ukraine and the resulting sanctions on major energy producers like Russia. Plus, that conflict directly hits the global food supply itself. Ukraine is, or was, a massive agricultural exporter, the breadbasket of Europe. A lot of the fighting is happening right on its richest farmland, which drastically cuts global supplies of grain and cooking oils, pushing prices up everywhere.
And layered on top of the geopolitics, there's the environment, climate change. Our sources are really starting to emphasize the accelerating impact of extreme weather.
Yeah, things like hurricanes hitting coastal areas, unprecedented droughts in farming regions, major flooding. Agriculture is right on the front lines of climate change impacts. There was a really stunning example cited from the 2022 and 2023 growing seasons right here in the U.S.
What was that?
A severe drought across the Midwest and the Great Plains reduced America's domestic wheat output by a terrifying 37%.
37%, that sounds historical.
It is. That figure is comparable to the kind of crop devastation they saw during the Dust Bowl back in the 1930s.
Wow.
So when you pile up geopolitical shocks like the Ukraine war, worsening climate instability like that drought, and the self-inflicted agricultural labor crisis we already detailed, you can see why food inflation feels so locked in. It's almost structural at this point, regardless of what the Federal Reserve does with interest rates.
Okay, so while ordinary Americans are grappling with this constant squeeze on necessities, the outside world isn't standing still. There are active moves underway to challenge the dollar's dominance. Which brings us to the geopolitical threat. Specifically, the BRICS economic group and what seems like China's strategic agenda.
Right. The BRICS group, that's Brazil, Russia, India, China, South Africa, plus newer members like Egypt, Ethiopia, Iran, the UAE, they are very explicitly positioning themselves as a direct, quote, counterbalance to the dollar-dominated global economic order. They're not being subtle about it.
How exactly do they function as a counterbalance? What do they offer differently?
Well, a key function is offering an alternative source of funding for development projects, primarily through institutions like their new development bank. They provide loans and investment to countries that are often, let's say, less interested in adhering to the traditional Western liberal order's focus on things like government transparency, human rights, or democratic norms. You see, under the usual U.S.-led system where institutions like the IMF and World Bank hold a lot of sway, countries that flagrantly violate those values often find it harder to get the international financing they need. BRICS basically steps into that gap. They offer financing, often with fewer strings attached regarding governance, and crucially, they're increasingly willing to conduct these deals and accept payments in currencies other than the US dollar. That directly chips away at the dollar's necessity in global transactions.
But the public message coming out of Beijing, which is obviously the biggest player in BRICS, often sounds quite reasonable, doesn't it? They talk about wanting a multi-currency world for greater global financial stability. They argue that relying so heavily on just one currency, the dollar, makes the whole system vulnerable when the U.S. economy hits a snag.
That's the narrative, yes. And it serves as effective political cover. Because while it's true that shocks in the U.S. economy do ripple outwards globally, we have to remember what that dollar dominance actually provided for decades. Our sources use this analogy of the benevolent Leviathan.
Okay, let's unpack that analogy. The benevolent Leviathan. What did the dollar, backed by U.S. power, actually give the world for roughly 80 years?
Well, think about the period after World War II. The U.S. dollar, underpinned by the world's largest economy and, frankly, its unmatched military power, provided a bedrock of global security and stability. This included things like ensuring freedom of navigation on the high seas, basically underwriting the safety of global shipping lanes, enforcing international contracts, and generally maintaining a predictable environment for global trade. The world accepted the dollar partly because the political and military might of the U.S. guaranteed that the system itself remained relatively stable. So the stability provided by this Leviathan, this superpower, benefited almost everyone, provided that the U.S. generally upheld, or at least paid lip service to, liberal democratic values.
And it's precisely that stability and perhaps those values that China sees as a threat.
Right.
Promoting democracy is seen as undermining the Chinese Communist Party's control.
Correct. According to the sources we looked at, China's real goal isn't balance, it's dominance, just cleverly disguised as a quest for stability. These sources argue that a world with multiple competing major currencies, the multipolar world Beijing claims to desire, is actually inherently unstable. It would likely foster unhealthy competition, currency manipulation between blocs, maybe even trade wars escalating into actual conflict as nations jostle for economic advantage. The argument is that if President Xi Jinping could have his way, the Chinese yuan wouldn't just coexist with the dollar, it would entirely replace it as the single global reserve currency.
But that's not really feasible right now, is it? The yuan can't just step in and replace the dollar tomorrow.
No, not yet. And the main reason is China's own currency structure. The yuan isn't freely convertible. The Chinese government keeps tight controls on its value and how it moves across borders. Think about it. No major global bank or country wants to hold massive reserves in a currency if the government that issues it can suddenly freeze those assets or drastically devalue the currency overnight for purely political reasons.
Right. The dollar's strength comes partly from its openness, its depth, its liquidity.
Yeah.
Anyone can trade it pretty much anywhere, anytime.
Exactly. China knows that to truly challenge the dollar, it would have to open up its financial markets far more, allow the yuan to float more freely. But doing that carries enormous risks for the Communist Party's political control over the economy. It's a fundamental paradox, and that's what currently limits the yuan's and, by extension, BRICS' ability to truly supplant the dollar system.
Okay, this is a lot to take in. Let's try to synthesize everything now. We've got these severe internal problems, the jobs data fudge, the crushing debt service costs, the self-sabotage from tariffs, and the farm labor crisis. And then we have this relentless external pressure trying to erode the dollar's dominance. How do all these different pieces, these different threats, actually interact to create the kind of catastrophic scenario our sources seem to be warning about?
The real danger, the key insight from the sources, is the simultaneous weakening across so many different, seemingly unrelated sectors. Normally, an economy might handle a shock in one area if others are strong. But right now, think about it, the federal debt service is draining national resources, pushing us towards that terrifying 25% interest threshold, leaving less money for everything else, including investment. At the exact same time, tariffs are actively slowing GDP growth by making trade harder and raising costs for consumers and businesses. And simultaneously, the agricultural collapse is forcing us to rely on expensive imports, which hammers household budgets even more, especially for food.
It really sounds like a perfect storm scenario. Each problem makes the others worse, and together they strip away any resilience the economy might have had to absorb a blow.
That's exactly the picture painted. This convergence leads directly to a rapidly cooling economy. You see mounting job losses more than just the BLS revisions suggest. You see America's buying power decrease on the world stage, which makes those necessary imports even more expensive. So ordinary people face exponentially higher costs for essentials like food and housing, while the government has less capacity to help. It's the ultimate domino effect. Unsustainable debt creates financial fragility, bad policy choices choke off growth, and these deep structural weaknesses, like the farm crisis, lead to hyper-expensive imports.
And it's right at this moment, when the U.S. is arguably at its most vulnerable domestically, that it becomes maximally exposed to some kind of major external shock.
Exactly. Something like a new pandemic, a string of devastating natural disasters fueled by climate change, or, and this is the one the sources emphasize most critically.
And this isn't just theoretical what-if-war scenario, is it?
No. This is where the timeline gets frighteningly specific. Our sources explicitly note that one potential shock isn't just possible, it's being actively prepared for. The U.S. Defense Department is currently seriously preparing for the possibility of war with China in the Pacific. Now, the drivers for that potential conflict might be primarily geopolitical, not economic, but the economic consequences of such a war, especially now, they would be absolutely catastrophic.
A major great power conflict, the first for the U.S. in generations. Hitting at the precise moment, the financial system is stretched thinner and is more brittle than perhaps ever before.
That specific dangerous context, the convergence of internal weakness and extreme external threat, is why some experts feel confident enough to offer a relatively tight prediction. Based on putting all these pieces together, the soaring internal costs, the debt reaching saturation levels, the structural economic weaknesses, and this peak geopolitical tension they forecast, that 2027 or maybe 2028 could realistically be the year the American economy finally crashes. And the tragic conclusion from many of these analyses is that if or when it happens, the failure will be largely self-inflicted. Driven by this toxic combination of decades of unsustainable debt accumulation finally coming due, mixed with recent domestic policy choices that actively eroded the very pillars holding up the dollar's strength.
Wow. That is an essential and definitely sobering deep dive into the data and the analysis behind those flashing red lights. Just to recap the absolute key takeaways for you listening, we saw that quiet but significant deception in the BLS job numbers that really shook trust. We saw the staggering scale of the debt interest payments now costing more than national defense. We unpacked that tragic, costly irony of the agricultural labor crisis, how it's forcing us to rely on expensive tariff-hit imports, driving up food costs. And then that final specific prediction looking towards a potential catastrophic crash around 2027 or 2028, possibly coinciding with an incredibly costly conflict.
And while, of course, no economic future is ever guaranteed, the consensus from the sources we examine is that the risks facing the U.S. economy right now are truly unprecedented. What really stands out, I think, is the degree to which these risks feel self-inflicted, the deliberate path taken on national debt, the tariff policies that seem to ignore the reality of our shrunken manufacturing base, the domestic policy shifts that crippled a sector as vital as agriculture. These feel like choices that have steadily eroded those three pillars of the dollar's strength from the inside out, leaving the U.S. maximally exposed to external shocks.
It's a powerful summary. Now, here's a final thought to leave you with, something that came up tangentially in our sources but feels incredibly important. They focused heavily, as we have, on the threats to the U.S. economy. But they also briefly touched on the fact that China's economy is facing its own massive structural problems, huge real estate debt bubbles, a looming demographic crisis with an aging population. So if the world's two biggest economic engines, the U.S. and China, were to face simultaneous catastrophic crises, perhaps around that same 2027, 2028 timeframe, what mechanisms even exist today to stabilize the global financial system, a system that has become utterly dependent on both of them functioning. What happens when both leviathans falter at the same time, when there's no single stable anchor left? That's the truly provocative question we'll leave you to ponder. Thanks for joining us for this deep dive.